Usually, when we look at a company's financial health, there is this underlying expectation of like total mechanical precision.
Right, you want the math to be clean.
Exactly. You check the dashboard of a car, and the speedometer tells you your exact velocity. The fuel gauge shows, exactly how many gallons are left in the tank.
And if the check engine light comes on, the mechanic plugs in that OBD2 scanner, and it spits out a definitive error code.
Yeah, it's binary. It is clean, it is measurable, and most importantly, I think it's comforting.
Sure.
But we are analyzing the Q4 2026 earnings call transcript and the official company profile for Conagra Brands today, ticker symbol CAG. And I gotta say, Conagra's check engine light is just flashing red right now.
Oh, absolutely flashing. The gauges are spinning wildly.
But somehow the car is still bombing down the highway. So today, our mission for this deep dive is to tear apart their financials to find out if this engine is about to, completely explode, or if the new CEO is just tuning it up while the vehicle is still in motion.
Which is a dangerous game. Diagnostic muddy waters are really the hallmark of any major corporate transition.
Yeah.
We are looking at a financial landscape here where the symptoms could indicate a catastrophic structural failure, or, and this is a big or, they could simply mean management is actively rebuilding the transmission. I mean, Conagra has been a staple in American pantries since, 1919?
Yeah, over a century.
Right. They operate massively across grocery, snacks, refrigerated, frozen, food service. I mean, you know the names. They are the engine behind Birdseye, Marie Callender's, Duncan Hines.
Healthy Choice, Slim Jim.
Exactly. Ready Whip, Angie's Boom, Sick Cup Up. When a portfolio that massive starts showing systemic strain, the stakes for shareholder capital reach a really critical threshold.
The signals coming out of this earnings call are honestly incredibly mixed. So we are going to cut through the executive phrasing today, extract the raw data from their Q&A, and deliver a heavily opinionated breakdown for you.
Because you really need to look at the scoreboard before you can understand the strategy.
You do. And spoiler alert for anyone holding this stock, the top line metrics are going to make value investors wince.
Oh, big time.
Yeah, so let's just get right into the headline numbers. The guidance for the upcoming year projects organic net sales to be down roughly 2%.
Right.
And the primary driver for that drop is the expectation that physical volume, like the actual number of boxes, bags, and cans they are shipping to distributors, is going to drop in the mid-single digits.
Which is huge.
It is. In this industry, a mid-single digit volume decline translates to millions of fewer products actually moving across the scanner at the grocery store.
Yeah, the disparity between that 2% drop in net sales and the much steeper 4 to 5% drop in physical volume, it really highlights the fundamental pricing mechanism that's keeping their top line afloat right now.
Explain that for the listener, because the math feels a little disconnected at first glance.
Yeah, so Conagra anticipates a price and mix impact of roughly positive 3%. So they are intentionally selling fewer items, but they are charging a higher premium for the items that do actually leave the warehouse.
Right.
That 3% price hike acts as this financial shock absorber, basically. It artificially inflates the revenue figures to kind of mask the severity of the physical volume decline.
Masking is the perfect word for it. But relying on price hikes as a shock absorber has severe consequences on the bottom line. Let's look at the operating margins, because this is where the real pain is.
Yeah, it gets ugly here.
It really does. They are officially guiding margins to land between 10% and 10.5% for the year. And that figure is alarming because just a few years ago, Conagra was boasting robust 16% operating margins.
Right. You don't accidentally lose roughly a third of your margin profile.
Exactly. And the immediate short term looks even bleaker, with Q1 operating margins specifically expected to crater into the high single digits.
Yeah, that Q1 margin compression is severe. And it is heavily influenced by a specific $40 million headwind that management referred to as a tariff wrap.
A tariff wrap. Okay, that sounds like intense Wall Street jargon.
It totally is, but it's compounded by a brutal macro environment. The macroeconomic reality they are operating in involves persistent structural inflation that's running at a 5 to 6% clip across their entire supply chain.
Okay, so wait, let's break that down. A 5 to 6% inflationary environment means every single input is compounding in cost, right?
Every single one.
The raw agricultural commodities, the corrugated cardboard they use for packaging, the diesel for the freight trucks.
The hourly wages at the manufacturing plants.
Right. And management claims they are fighting this by targeting productivity gains of above 4%.
Which just doesn't cover the spread.
The math there is so unforgiving. If inflation is eating 6% of your capital and your internal cost-saving initiatives are only recovering 4%, you are structurally bleeding margin.
Exactly.
That persistent gap is the exact reason they are forced into that 3% price hike we just talked about.
Right, they have no other choice. But the terminology management uses to kind of explain away these margin hits requires some careful translation. During the call, Matthew Nicias, he's the Senior Director of Investor Relations, he leaned really heavily on that $40 million tariff wrap to explain the Q1 weakness.
So what does that actually mean for the retail investor listening to this?
So in financial modeling, lapping or a wrap refers to the year-over-year comparative baseline. When Wall Street models Q1 2027, they index it directly against Q1 2026.
Right.
Last year, Conagra benefited from several favorable one-time offsets and mitigations related to tariffs that temporarily padded their gross margins.
Okay, so they had a lucky break last year that artificially inflated the baseline.
Exactly.
Now that those temporary mitigations have expired, they're facing a $40 million comparative vacuum right out of the gate in Q1.
Yeah, the underlying business hasn't necessarily degraded by $40 million overnight. It's rather that the GAAP accounting standards force a comparison that just makes the current quarter look substantially weaker.
Wow. So the baseline effect is just a harsh reality in public markets. It over-indexes the negative sentiment specifically into the first quarter.
It does. However, the far more critical concept determining their fate this year is how they actually model consumer behavior.
Right, because at the end of the day, someone has to buy the frozen peas.
Exactly. And the new CEO, John Brasi, who was, by the way, only 45 days into the job during this call.
Which is wild.
It is. He explicitly stated they are assuming higher than historic elasticities in their modeling.
Okay, let's pause there because price elasticity is probably the most vital metric for anyone holding consumer staples in this economy.
Oh, without a doubt.
I look at it like stretching a thick rubber band. Conagra is holding one end of this rubber band and the consumer's wallet is holding the other.
That's a great way to picture it.
Right. And for the past 3 years, unprecedented input costs have forced Conagra to just keep pulling on that rubber band, raising prices relentlessly to cover their own shrinking margins.
Yeah, just pulling and pulling.
We are at a point now where they are betting they can stretch that price tag by another 3% this year before the consumer completely snaps and switches permanently to a cheaper private label store brand.
And that's the danger zone. The concept of cross-price elasticity dictates that if a premium brand raises prices while the generic alternative holds steady, the widening price spread just accelerates volume destruction.
Because a frozen meal or a bag of popcorn is a highly elastic product.
Very elastic. If the price becomes unpalatable, the consumer doesn't just grit their teeth and buy it anyway. I mean, they trade down or they substitute entirely by just cooking from scratch.
Right.
By admitting they are modeling for higher than historic elasticities, Brasi is acknowledging that the consumer is stretched to a breaking point. They are preemptively baking that mid-single-digit volume abandonment directly into their financial guidance so they don't walk into an earnings miss later in the year.
Yeah, and the analysts on the call, they were circling this exact vulnerability like sharks.
Oh, they smelled blood in the water.
David Palmer at Evercore ISI and Alexia Howard at Bernstein, they both zeroed in on this elasticity assumption. Matthew Nicias attempted to soothe the room by noting that while they are leaning into higher elasticity assumptions for the frozen segment, they expect closer to historical one-to-one elasticity for grocery and snacks.
Which is optimistic.
It is. The massive risk here is miscalculating the consumer's exhaustion level. If the rubber band has already lost all its tension, that mid-single-digit volume drop could violently accelerate into double digits.
And at that point, a 3% price hike doesn't protect your revenue. It actively destroys it by driving your most loyal customers into the arms of your competitors.
Yeah, you just lose the customer forever. But the structural loss of margin we are dissecting here, it isn't solely a symptom of recent inflation.
No, it's not.
It is the radioactive fallout of a deliberate multi-year strategy executed under the previous leadership regime that just fundamentally backfired.
Yeah, to really understand how Conagra painted themselves into a corner where they have to accept volume destruction just to maintain a 10% margin, we really have to look at the strategic pivot that's currently underway.
And this brings us to the executive drama that caused alerts to go off on phones everywhere. The biggest shockwave for retail investors, like the ultimate cardinal sin for a legacy CPG company, was the announcement of a massive dividend cut.
Yeah, that was huge.
Slashing the dividend alters the foundational thesis for why thousands of income-focused portfolios hold this stock.
It does. But the mathematical reality behind that deeply unpopular decision is just staggering. Management slashed the dividend to intentionally retain roughly $1 billion in incremental cash flow over the next 3 years.
$1 billion.
Yeah. They are hoarding a massive war chest that historically would have just been distributed to shareholders.
And they aren't just parking $1 billion in a high-yield savings account, right?
Okay.
They're aggressively weaponizing that capital.
Where they have a plan for it.
They have earmarked this newly freed up cash for two specific high-leverage areas. First, they are stepping up A&P, which is advertising and promotion, by an incremental $40 million for the year.
That's a massive increase.
It is. It's a 14% increase in their marketing spend. They're essentially trying to buy their way back into the consumer's consciousness, trying to remind shoppers why a Slim Jim commands a premium over a generic gas station beef stick.
Exactly. And the second area of reinvestment is an incremental $125 million in CapEx, or capital expenditures. They are deploying hard capital to build physical supply chain resilience and to restructure their manufacturing footprint.
Right.
John Brasi was remarkably candid on the call about the failures of the past few years. The previous regime, they invested heavily to drive sheer volume.
Just moving boxes.
Yeah, exactly. They prioritized moving boxes and capturing market share, and they often relied on heavy promotions and discounts to keep the top line moving. While that strategy kept the factories humming, it severely eroded profitability, dragging them down to that fragile 10% operating margin we talked about.
So Brasi is pivoting the entire philosophy of this multi-billion-dollar enterprise.
He has to.
He is actively willing to sacrifice volume to rebuild the margin profile through what he calls inflation-justified pricing, specifically targeting the frozen segment as the proving ground for this.
Right.
I just got to say, the sheer audacity of a CEO, only 45 days into his tenure, walking into an earnings call and slashing the dividend while forecasting negative volume is just a masterclass in corporate expectation management.
Oh, absolutely. We are witnessing a textbook execution of kitchen sinking here.
Kitchen sinking.
Yeah. When an incoming CEO inherits a structurally flawed operation, attempting to maintain the unrealistic projections of their predecessor is career suicide.
Because you'll inevitably miss the targets.
Exactly. If they fail, the market blames the new leadership. Instead, the strategic move is to throw everything but the kitchen sink into the first earnings report. You take the write-downs, you lower future guidance to rock bottom, you cut the sacred dividend, and you establish the lowest possible defensible baseline.
Right. You take a massive concentrated PR hit on day 45, knowing that the only trajectory from that artificially lowered floor is upward.
Exactly. If Brasi had waited 12 months to cut the dividend, the narrative would be that he lost control of the company.
Oh, totally.
But by doing it immediately, he frames the narrative as fixing a broken foundation. Rob Moscow at TD Cowen even challenged Brasi on the call, asking if he considered setting the earnings base even lower down to like $1.20 EPS, just to completely clear the deck of any downside risk.
Wow, just bottoming it out completely. Yeah. Establishing a baseline for profitable growth is intellectually sound, I get it. But the operational reality of this pivot is incredibly dangerous. Max Gumport from BNP Paribas, he highlighted a statistic that illustrates the sheer gravity of Conagra's situation. Based on this new guidance, organic volumes are now projected to decline for a sixth consecutive fiscal year.
6 years! It's almost unheard of.
Outside of the tobacco industry, where a steadily dying customer base is literally factored into the business model, I am struggling to find a precedent for a CPG company surviving 6 years of shrinking physical sales without just spiraling into structural irrelevance.
It's a massive red flag.
Because the economics of food manufacturing rely entirely on fixed cost absorption. You have these massive, highly regulated factories with immense overhead, electricity, maintenance, property taxes, salaried plant managers.
Yeah, that overhead doesn't change whether you make one box or a million.
Exactly. If you are pushing millions of fewer units through those same factories for 6 straight years, your fixed cost per unit must be skyrocketing. So the question is, at what point does the strategy of choosing margin over volume simply become the managed decline of a dying empire?
That is the multi-billion-dollar question.
Mm-hmm.
The tension between overhead absorption and gross margin is the defining existential threat for Conagra right now. In a high fixed cost environment, volume is your absolute best friend because it dilutes the overhead across millions of units.
Right.
When that volume evaporates, the overhead crushes your unit economics. But Brasi's counter thesis is that purely chasing volume creates empty calories for the balance sheet.
Empty calories, I like that.
Right. Selling a frozen dinner at a near loss just to keep the factory line running destroys long-term shareholder value. The entire pivot is a desperate search for equilibrium. They are betting that the $40 million A&P injection will convince a smaller but highly loyal consumer base to absorb the higher prices, creating a smaller revenue footprint that generates vastly superior cash flow.
And the roadmap for deploying that retained capital is highly specific, and the timing of their actions dictates the entire financial modeling for the next 2 years for anyone holding this stock.
Yes, the timing is everything here.
Let's look at the timeline for this inflation-justified pricing. They aren't implementing these price hikes immediately, are they?
No, they're not. Matthew Nicias clarified that the bulk of the new pricing actions will hit in the middle of their second quarter.
Right. So the mid-Q2 implementation is a critical nuance for you to understand. For the entirety of Q1, they are absorbing the full brunt of 6% inflation and that $40 million tariff wrap without the protection of higher prices.
They're just eating the cost.
Exactly. Because the hikes hit mid-Q2, fiscal year 2027 will only capture roughly 6 months of pricing benefit.
Right, which mathematically sets up a massive comparative advantage when we roll into fiscal year 2028.
Yeah, the baseline drops.
Exactly. In the first half of next year, they will be lapping the pre-hike numbers of FY27. So assuming the consumer doesn't completely abandon the brand, their revenue and margin expansion in FY28 should look spectacular simply because the baseline comparison will be so weak.
It engineers a highly favorable financial wrap for the future. But the most compelling defense against the macro environment isn't even the pricing strategy. It is the capital expenditure. Management confirmed that CapEx will run at the absolute upper limit of their long-term target, hitting 4 to 5% of net sales.
Which is a huge structural shift.
Crucially, $100 million of that step-up is dedicated to massive insourcing projects.
Yeah, insourcing is huge. Basically, insourcing means aggressively pulling manufacturing processes away from third-party co-packers and building out the internal infrastructure to do it themselves.
Right.
They explicitly called out bringing the manufacturing of protein and fried chicken in-house.
Fried chicken.
Yeah. The goal here isn't just shaving a few cents off a product. It is engineering a 98.5% supply chain service level with zero disruptions.
And the complexity of manufacturing frozen fried chicken is immense.
Right. It's a nightmare.
Yeah.
A company must source the raw avian protein, manage the breading and frying process, execute instantaneous blast freezing, often using individual quick freezing technology just to maintain cellular integrity, and then manage the entire cold chain packaging process.
It sounds incredibly capital intensive.
It is. When a brand relies on a third-party co-packer to execute that sequence, they are paying the co-packer's overhead, their labor costs, and their profit margin on top of the raw materials.
So you are basically renting your own supply chain.
Exactly.
And the hidden risk there is devastating. Because if that co-packer experiences a labor strike or a catastrophic machine failure or even a localized power grid issue, Conagra suddenly cannot deliver Marie Callender's chicken pot pies to Walmart distribution centers.
And retailers do not forgive that.
No. When a major retailer faces empty shelf space, they penalize the brand, and you risk permanently losing that highly coveted grocery store real estate to a competitor who actually has product.
Right. Taking ownership of the fried chicken manufacturing gives Conagra total vertical control, eliminating that third-party margin stack. This is really the most brilliant long-term defense against 6% macro inflation.
Yeah.
Because when a company relies solely on price hikes to fight inflation, they are engaging in a dangerous game of chicken with the consumer.
Literally a game of chicken in this case.
Right, pun intended. But by spending $100 million to build highly efficient automated production lines, they are permanently lowering their cost of goods sold. A structurally lower cost base protects margins infinitely better than just constantly punishing the shopper at the register.
Right. They are using the dividend cash to buy permanent margin expansion rather than renting it quarterly through these elasticity testing price hikes.
Exactly.
And while they are building massive new chicken lines,
Yeah.
they are simultaneously taking a chainsaw to the rest of the portfolio.
Oh, this is the best part.
John Brasi admitted that Conagra currently manages a staggering 5,500 individual SKUs or stock keeping units.
5,500, it's absurd.
He flatly stated that the portfolio is too large, too complex, and inherently inefficient.
Yeah, managing 5,500 distinct product variations is a logistical nightmare. Every single individual SKU requires unique ingredient sourcing, distinct packaging design, specialized factory line changeovers, and individual slotting fees paid to retailers just to place it on a shelf.
Right. The shelf space isn't free.
Exactly. The operational drag of managing thousands of low-velocity items just destroys working capital.
I look at a 5,500 SKU portfolio exactly like a massive, heavily cluttered garage.
Yeah.
For a decade, every time a marketing team had a brainstorm, like a slightly spicier beef stick or limited edition strawberry popcorn or some regional variation of a frozen bowl, they just manufactured it and tossed it into the pile in the garage.
Just threw it in there.
Right. And now the complexity is suffocating the core business. So Brasi is launching what he calls Project Catalyst to review every single product from the bottom up.
Which is so overdue.
He is dragging every item out of the warehouse and demanding it justify its existence. Does this specific flavor of popcorn generate enough standalone profit to warrant the factory downtime required to produce it? Or is it just gathering dust and eating up expensive cold storage space?
Right. Project Catalyst represents a zero-based approach to product lifecycle management. Every SKU that is eliminated instantly frees up working capital. It means less raw material sitting stagnant in a warehouse.
Yeah.
It reduces the frequency of cleaning and resetting factory lines, which radically improves hourly throughput and productivity. It basically allows the sales force to focus entirely on high-margin, high-velocity core products. Brasi also hinted at a top-down strategic review over the mid to long term, which implies the pruning won't stop at just individual flavors.
You mean entire brands?
Yeah, we could easily see the divestiture of entire underperforming brands.
We will definitely have to monitor their investor day in early 2027 to see the body count from Project Catalyst.
Oh, it's going to be a bloodbath.
But all of this operational restructuring, the insourcing, the SKU rationalization, the massive marketing push-it-all serves one ultimate master, which is the balance sheet.
How is the balance sheet?
They cut the dividend to free up $1 billion, and while they are spending some of it on CapEx, their absolute highest priority is debt paydown.
Right. The company is hyper-focused on deleveraging back to a firm 3.0x leverage target. This is the North Star metric for the rating agencies. And the timeline is heavily compressed because they have significant debt maturities coming due in October.
Right.
Navigating a high interest rate environment with looming maturities requires massive liquidity.
So they are evaluating a mix of commercial paper, term loans, and public notes to handle the October refinancing.
Yeah.
The only reason the credit markets aren't actively panicking right now about Conagra's debt load is the sheer velocity of their cash generation. Because despite the ugly margin compression on the income statement, Conagra boasts a massive 119% free cash flow conversion rate for the year.
Which is exceptional.
Explain how that works, because converting it over 100% sounds like a typo to most people.
Yeah, it sounds like fake math. 119% conversion rate means that for every single dollar of net income they report on the P&L, they are actually generating $1.19 in raw liquid cash.
Right.
This discrepancy exists because net income includes non-cash expenses like depreciation, but more importantly, it reflects aggressive working capital management. Matthew Nicias highlighted that they are actively bleeding down their inventory levels.
Okay. So when you sell off existing inventory without immediately spending cash to replace it at the same volume, you unlock massive amounts of trapped capital.
Exactly. You turn those sitting boxes back into cash.
They have sustained over 115% conversion rate for 3 consecutive years now.
Which is incredible discipline.
It is.
Yes.
The income statement might look like it took a beating, but the cash flow engine is running incredibly hot, providing the absolute liquidity necessary to service the October debt and march toward that 3.2x leverage ratio.
Right. So we have translated the raw Q4 data, dissected the psychology behind the dividend cut, and really mapped out the operational timeline for this insourcing and SKU rationalization. Synthesizing these elements requires taking a definitive stance on the viability of shareholder returns moving forward.
And based on the evidence in the earnings transcript, our stance is firm. For you listening, we are aggressively bearish on Conagra in the short term, but cautiously optimistic in the long term.
Yeah, the next 6 to 9 months are going to be agonizing for current shareholders.
Brutal. The dividend cut fundamentally alters the investment thesis, removing the primary incentive for income investors. The Q1 operating margins plummeting into the high single digits, that will generate brutal headlines.
So the financial press will have a field day.
Digesting a sixth consecutive year of negative physical volume is just a psychological hurdle that many institutional investors will straight up refuse to cross.
Yeah, the short-term dashboard is lit up with warning signs. However, the long-term mechanics of the turnaround are incredibly sound. John Brasi is executing the intensely unpopular but fundamentally necessary choices that legacy turnarounds require.
Right, he's refusing to kick the can down the road
Yep.
with artificial promotions like the last guy.
Exactly. By sacrificing immediate payouts, he is fortifying the balance sheet against a brutal macro environment. Deploying $100 million into supply chain ownership permanently fixes the structural COGS issue, treating the underlying disease rather than just medicating the symptoms with endless price hikes.
For the retail investor listening, this dictates very specific actionable steps. If you hold CAG purely for the dividend yield, if this was a bedrock income generator in your portfolio, you must reevaluate your position immediately.
Yeah, get out.
The company has purposefully dismantled that cash cow. Conagra is no longer an income play. It is a long-term turnaround and growth play. If that doesn't align with your risk profile, the thesis is broken.
Right. Conversely, if you are a value investor looking at the depressed stock price and considering initiating a position, the data strongly suggests keeping your capital on the sidelines until the Q3 earnings report.
Because initiating a position before the elasticity data is proven is just pure speculation.
Exactly.
You wait for Q3 because the mid-Q2 price hikes are the ultimate crucible for this entire strategy. You need empirical proof that the price hikes actually stuck without triggering a mass consumer exodus.
Right. You need to see the numbers.
If the Q3 data shows that margins expanded and volume held relatively steady despite the higher price tags, well, then you have mathematical verification that their pricing power is intact and the long-term turnaround is viable.
Yeah, until then, you are just catching a falling knife in the dark. The turnaround hinges entirely on the consumer's willingness to accept the new pricing reality.
Before we wrap up, there is one final really provocative thread from this earnings call that requires you to look beyond the spreadsheet and into the physical economy.
Yeah, this is the real test.
Management confidently asserted that their frozen portfolio spans the full value spectrum. They argued that because they offer premium healthy bowls alongside budget-friendly multi-serve family meals, they are insulated from cash-strapped shoppers who are trading down.
They believe they can capture the consumer at literally every price point.
Right. But as they aggressively force another 3% price hike to combat persistent 6% inflation, could they mathematically price their entire portfolio out of the freezer aisle?
It is the ultimate real-world test of brand equity versus economic reality. Because if the budget-friendly family meal becomes too expensive, the consumer doesn't trade down to a smaller Conagra product. They trade laterally to a private label.
To the store brand. The real-time data for this company isn't going to show up on a Bloomberg terminal first. It is going to show up in aisle 4 of your local grocery store. Next time you're walking past the freezers, just observe the behavior of the shoppers around you. Are the Marie Callender's chicken pot pies actually making it into the cart? Or are they being swapped at the absolute last second for the generic store brand equivalent sitting just inches away?
Because if the everyday consumer decides the premium is no longer justifiable, the elasticity model shatters, and all of Conagra's margin math just falls apart.
We started by looking at a corporate dashboard expecting precision, only to find the gauges spinning wildly. Conagra is actively ripping out the transmission while the vehicle is still at highway speeds.
It's going to be a bumpy ride.
The metrics are going to look incredibly messy for the next few quarters. Your edge as an investor isn't to panic at the flashing warning lights, but to understand the exact mechanics of what management is fixing under the hood. Thank you for joining us for this deep dive. Keep scrutinizing the data, demand proof of pricing power, and stay sharp out there until the next earnings call.